The purpose of this video is to bring awareness to ETFs and mutual funds. This would be more of a thought experiment besides going through any math. For most investments, example, the stock market, it's more about time in the investment besides timing the investment. The money would have a longer time to compound, making you more money. Relating back to my compound effect talk, if someone made 10% of $100 in 12 months, the person would have $110. If somebody was in an investment for 6 months, half the time, the person would either need to find an investment that gives 20% off of the $100, which is more of a risky investment, or just something a person new would not know exactly how to get that type of return. Or the person would need to put in $200 at 10%. For the scenario of pay off debt or invest first, just like the answer to most things in life, it is always, it depends. You should know the type of person you are. Does something always just come up? Do you need to keep going into debt because an unexpected bill or major event keeps happening to you? This would indicate that you should not wait to try and pay off your debt before investing. After paying off your debt, are you really going to have twice the amount of money to invest to play catch up? Do you have the knowledge of what the risky investments that gives 20% or more in returns? Of course not, because something else will just come up and you will have to wait a bit longer and you'll research whenever you can. So, outside of a 401k or the like, a mutual fund or an ETF are good to start off. Both are managed by other people. Some have been around for over 10 years, however, they both do come with a fee. Let's look at Vanguard's differences between ETFs and management funds page. If you prefer lower investment minimums, this is telling us that ETFs can be bought at one share. For instance, Vanguard S&P 500 ETF is about $407 as of September 17, 2021. And mutual funds, some have an entry point of $3,000, where we see here the Vanguard Growth and Income Fund is at minimum $3,000. So for this category, it depends on how much money you have to start to initially invest. If you want more hands-on control over the price of your trade, this is how active do you want to be in investing. ETFs you can buy and sell when you want. Mutual funds, the trade occurs at the end of the day. For me, when I was in a mutual fund, it was around 2007 and 2008, and I put in a sell early day, and it got sold by the end of day, and the fund significantly dropped by that time. If you want to repeat specific transactions automatically, if you want to put your investments on auto and not think about it, you would need a mutual fund. ETFs are manual and you would have to dollar cost average yourself. If you are just starting out, you may sometimes forget to buy additional funds. If you're looking for an index fund, index funds are normally the cheapest in cost or expense ratio. ETFs are mostly passive investments and the management does not have to actively buy, sell, and research stocks. There are some index mutual funds as well though. Let's look at this S&P 500. We see the expense ratio is 0.03%. Now we go to the Vanguard Growth and we see the expense is 0.32%. So the expense ratio of the mutual fund is 10 times greater than the expense of the ETF. Since some ETFs and mutual funds are both a collection of stocks, the fear of losing your money overnight might never happen since hundreds of companies would have to get hit very quickly. Loss of money, whether capital or unrealized gain, will occur. The stock market on a small scale is constantly in flux and goes up and down, while in the very long term, and generally, the stock market goes up. So let's look at this S&P 500 ETF again and see what does it comprise of. It has the number of stocks of 507. And the top 10 holdings that it has is Apple, Microsoft, Alphabet, Amazon, Facebook, Tesla, Nvidia, Berkshire, JP Morgan, Johnson & Johnson. Let's look at the mutual fund of the growth and income fund investor. The number of stocks that it has is 1,526. The top 10 holdings are Apple, Microsoft, Alphabet, Amazon, Facebook, Berkshire, Tesla, Johnson & Johnson, Qualcomm, and Nvidia. So for this ETF and this mutual fund to go to zero overnight, something would have to happen to all of these major companies. Over 1,000 companies would have to drop to zero. Again, there is a great chance that would not happen. If that ever did happen, something more greater towards the economy is going on. I know it's hard to start off. There's a lot of research and it can lead to analysis paralysis. My suggestion is to start off with one that invests in stocks. Of course, that depends on your time range and is mostly good for a long term outlook. I would say look for a very cheap one and buy some of it. Get used to doing more research and funding the fund while you have it. When you look through a list of funds, the vast majority seems to be doing well, and there's a good chance if you are new, you do not have the knowledge of what makes one of the fund returns 10% versus 12%. Okay, so let's go and show you a list of these funds. Investing ETFs, we're just gonna pick one. We're gonna browse a list of the funds. See, this first section is bonds, so we're gonna pass by that. And now we're at the stocks. And here there's the annual 10-year return and the inception return. You can go for something that has been around for a longer time. For instance, this has been around since 2006, whereas this one been around since 2018. So this one is more well established. So we see since its inception, it returned 10%, and this growth ETF, just 2 years longer, had returned 12%. That's again with the illustration that I stated earlier. There's no way for someone to know exactly why the growth ETF returned more than a dividend appreciation ETF. However, these returns are extremely great. Like getting any return is better than getting no return. And also, these returns are better than what you would get in a bank, and you will have access to your money at least within a 3-day time frame or so. Just for a slight correction, the returns was based upon the average annual return, so they were returning like 10% per year and not just 10% throughout its inception time.